Passive Pockets is presented by Equity Trust. Reaching financial freedom isn't always about accumulating more. It's often about asking whether your portfolio is actually getting you closer to your goals. Welcome to Passive Pockets, the passive real estate investing show, brought to you by Equity Trust. I'm Jim Pfeiffer, joined by Paul Shannon, and today our guest is friend of the podcast, investor and educator, Chris Lopez.
Chris shares how he recognized his own misalignment between portfolio and purpose and what he did to fix it, and how he's helping other investors do the same, all while reducing taxes and letting go of control without losing peace of mind. Let's get into it.
All right, Chris, super excited to have you here today. We want to start with just kind of talk to us about your journey. How'd you get into real estate and where'd you go from there?
All right. Well, glad to be back in the studio with you guys. I mean, my journey started like most people reading a very popular purple book called Rich Dad, Poor Dad just over like 20 years ago now. I'd actually gone to Virginia Tech for engineering and realized in the first few weeks that I was not the right person nor smart enough to be an engineer. And so I started going through the typical college, what the heck am I going to do? And then one of my friends gave me or lent me a copy of Rich Dad, Poor Dad. And that completely opened my eyes to entrepreneurship, real estate investing, like the B and I side of the quadrants, right? So that was a game changer for me. And originally I wanted to get into real estate, and this was like 2003-ish timeframe. So we're talking, 20 plus years ago now. Back then, I did not have much money, I had a couple $1,000 from college jobs, and the internet and resources like BiggerPockets and YouTube were not available back then. So I wanted to get into real estate, tried for a couple months talking to local realtors, got nowhere, and then really pivoted on entrepreneurship. I was like, well, let me learn business skills. Let me learn how to make money. And once I actually make some money, build that B business, I can take that money and become an investor, right? Did that, built a really cool internet marketing business, good cash flow. I was able to graduate college not needing a job, which is a really cool thing to brag about back then. And I thought I had achieved financial freedom, but I had not, because it was all like essentially self-employed income. I had some recurring income, some software stuff and some online affiliate marketing. And that was great until like the 2008 great financial crisis timeframe. And then that money mostly disappeared. I was like, oh, business income does not last forever. I need to really get over here on the investment side. So I spent 2 years day trading on the stock market and then the foreign currency market. Did not do well on those. I think I probably made like, 3 cents an hour when I look back at it, for my time in there, and lost some eyesight vision. But then in 2010, I bought my first rental property. I was actually doing a house hack back then. I didn't know it was called house hacking back then, but prices were obviously incredibly cheap. And I bought my first place because I could buy a place for about a third of what I could rent a place for in terms of like monthly cash flow. I was like, oh, this is a no-brainer. So I bought it, had a roommate, loved it. And then 2 or 3 years later said, wow, this real estate thing is awesome. I want to make this, I want to learn how to invest. And that's also where I shifted my business, because my business I built in college was just, it was time to move on from there. It had pretty much gone to not much. And so I made the shift back then to go from career-wise into real estate investing as a professional, and also made it my big focus to make money, to learn real estate investing, and also learn how to get networked into the proper deal flow. And then I made that shift. And then about 2013, 2014, I got very serious and very focused on it. And then it's just been a wild ride since then.
Great story, Chris. A couple pivots that were strategic, obviously, to where your goals were aligned. I'm curious to hear about the house hack happened, which is fantastic. And then from there, you built a single family portfolio, correct? What happened from maybe 2013 to, let's say, 18 or 2020?
There was a few steps, learning steps, right? It's always, you take a step forward, you get a black eye, you take 2 steps forward, get a black eye, and then investing in entrepreneurship. So I did the house hack, was living for free. I think my mortgage was $450 a month. It was insanely low. And I did a fix and flip, made money, hated it. I think like you, Jim, I was a one and done flipper.
Yes.
because I realized that's not investing, that's a business. And I don't have the skill set for the reactive deal sourcing, the GCing, and that was just not my cup of tea. And I was like, hey, I'm better at marketing because that was my background before I got into real estate. One of my previous marketing clients was a uber successful investor in Las Vegas. And I'm talking about like, he was literally had a show for a while on HGTV or one of those, channels on flipping. He would do 40 or flips a year, 40 or 50 flips a year. He'd wholesale out the other 20 or 30 deals that he didn't have the bandwidth for. And of course, he vacationed like 4 months out of the year. So he had like the lifestyle that everyone wants in real estate. And he's like, hey, Chris, I'm trying to take my real estate business into more of an online marketing manner because it's all postcards and probate lawyers. He's like, can you help me out? And I was like, heck yeah, I can, dude. Because I was like, dude, this is all on me. I'm going to learn the marketing. Then I'm going to copy and paste it to Denver, right? He was in Vegas. I was in Denver. I got smoked in wholesaling online. We did one deal on a little condo. I think we made $15,000 on about $45,000 of expenses. And this was back in like the open door heydays of like, those flipping companies where they would just spend ungodly amounts of money on marketing and they could just dump money that we couldn't and had a much better machine. I was like, okay, well, wholesaling is not the right thing for me. Next thing I tried was multifamily brokerage and realized I was like, I'm gonna learn all how to do investments. Well, multifamily brokerage is, hey, go make 4 cold calls a week. And I was like, okay, well, I don't mind working hard, but I want to learn investing fundamentals as well. Realized that wasn't for me. I was going through here. I realized that residential real estate market, the 1 to 4 units really fit my skill set in terms of like, hey, products I knew. I was in Denver at the time where that was a great time to start buying rentals, the early teens. And then I realized my focus is a long-term mindset. If I can invest in real estate over 20 plus years, I have a really high probability of, making money and building a really great, retirement portfolio one day. So I pivoted towards rental properties and really focus on just buying 1 or 2 rentals a year, buying, not the most amazing deal, but buying really good deals in the market, adding a little bit of value. And then as the market increased property values, as I increased some values to some light value add stuff, I would pull out money, cash out refi, buy a property, or sell a property and then do a 1031 exchange. And so I built a nice portfolio on there.
At the peak, what was your portfolio? What did it look like?
So I had 9 properties myself and a bunch of other partnerships on there. And this is all within like the Denver market. So fairly high price stores. So I had that. And then in 2019, I did my first LP investment as a passive investor, because my business was really taking off. I want to spend more time with my family, and the long-term rental numbers. I've always been like a long-term rental guy. I don't want to, mess with short-term rentals and that stuff. Just not my cup of tea. I made my first LP investment in 2019.
Awesome. So talk to us about kind of the realization that you had that your current portfolio was not meeting your needs or aligning with your long-term goals and your desired outcome. Was it that moment there where you transitioned to your first passive investment, you saw the light bulb come off?
It was actually quite a few years before then. So that first property I bought, it was a condo I purchased for about $67,000, and it was the best creative financing I ever did. I had a private lender lend me 100% of the value on a 15-year note at 5%. So it was a true zero down long term, and this was just a private wealthy individual. And of course, CDs were paying nothing back then, bills were paying nothing back then, and she believed in me and said, yeah, you're secured by a piece of real estate that was selling for $250,000 a couple of years ago. I'll bet on you. So I had that property. My mindset back then was, I bought this property for so cheap. I bought for zero down. Why the heck would I ever sell it, right? Buy the property, pay it off, live off the cash flow. And that was a plan for about 5 years. And then the problem was I started doing the math on there and I was like, when this is paid off, I'm not making much cash flow. I think once I looked at like the paid off NOI, it would be like $8,000 or $9,000 a year. So it was great, but not amazing. And I was like, oh, I need like another dozen condos, another dozen properties like this to achieve that. And with the way prices were going and all that, I was like, this is really, really tough for me to go do. And then one of my big realizations back then is one of my really great mentors said, hey, look, if your portfolio, if your rental property is underperforming the stock market, and he was talking about like return on equity, like how much equity you have in the property. He's like, if you're underperforming the stock market, is it worth your time to be a landlord with all the risk? And when I looked at it, I was like, well, if I'm making less than a 10%, not just cash on cash return, but like total return, I was like, yeah, if I can be hands off, no personal liability, we all go through the tenants destroying your property one day, all that jazz. I was like, yeah, this isn't worth it. I need to go out there and get into a better property or pivot to something hands off. So that was a realization that I started doing like the 1031 exchanges, the cash out refis, and had a really good model back then to, hey, based on cap rates and where interest rates were and all that stuff, what made the most sense to do, that I started really leveraging my portfolio. And that worked great when, the market back then was just going up and to the right? Hey, cash out refi, buy a property. We're all amazing investors back then. It was about 2018, 2019, the numbers just kind of stopped working in Denver, where interest rates started creeping up. I think a lot of people were rates were creeping up before the COVID stuff. And we were such a high appreciating market that we had really low cap rates and very poor cash on cash returns. So I was like, I've got to figure out something else. I can't do this playbook of 1031s or cash out refis anymore. I did not want to do out of state investing. I didn't want to go invest in Kansas or Ohio or Tennessee, nothing against those markets. But I knew what it took to manage a rental property. And having to fly to another state to manage a single family home was just not worth the squeeze and outside my area of expertise. But I had a couple investors around here, investor buddies, where they had scaled their business from, some single family, some fix and flips, starting to do like the multifamily value add stuff. And I was watching them grow and I was like, oh, these numbers work better. And I can just have my capital work harder like I want to, but I'm not taking the personal, operational and personal guarantee, liability.
So there's a few components here, right? One is a return on equity, especially on properties. I think the lower loans you have, the lower the return on equity, right? So there's that part. And there's also, hey, I need to diversify, or I don't want to do, the hands-on stuff anymore. So can you talk a little bit more about both of those, specifically the equity? Because in a minute, we're going to talk about your program that kind of helps people understand when and if they should shift strategies, right? So can you talk about, because I don't think people look enough at the evaluation of what is my equity actually earning me on these long-term hold properties, right? Because as you said, if you're not earning as much as the stock market, then, what are you doing?
I can talk for hours on this, Jim. You open a can of worms, buddy. I'm sharing my screen here. I know a lot of people aren't able to watch, so I'll talk through numbers, but this is some modeling I've built out for I did years ago, and it's gotten more advanced as I've gotten more advanced. But this was actually the first condo I bought. And you can see down here, I bought it, actually this was January 2011. I bought for $67,000, right? And I sold this property in, I think, 2017 or so, did a 1031 exchange. But these were numbers when I sold in 2017 timeframe here. The property had appreciated from about $67,000 to about $230,000. And I was at a 10% LTV, meaning I had about $24,000 left in my loan balance on there. So very, very low LTV, right? I was very close to paying off. And I had a lot of equity in there, not from anything I did good. It was just, hey, I bought a good property, waited, was patient. The market gave me a lot of appreciation. And then here was my mindset at the time. I'll see how good you guys were with math this morning. If I put zero down on the property, I'm making money. What's my return? Infinite, yes. My first money out was not until a month later for my first HOA, my first mortgage payment. So I was actually making an infinite return, which felt really cool to go out there and kind of brag about to my friends. I'm making an infinite return on this property, right? And then this is where my mentor was talking about the stock market. He said, hey, don't look at your investment. Look at your return on equity. And so the way that I've defined return on equity is take the 4 ways to make money in real estate. And so it's like a snapshot in time. It says, hey, from this period for the next 12 months, what can we expect to make over the next 12 months to 1 year in time frame? And so I think I had a 3% appreciation assumption. So I'd make $6,900 in appreciation that year. I would make about $5,200 in debt pay down from this, paying down some principal on my mortgage. I was making about $1,600 a year in cash flow. And I was getting, about $450 in depreciation benefit, right? Really low depreciation because it was, a very low basis in the property. So from a very gross level return, I was going to make about $14,000 next 12 months off this property between all 4 ways to make money in real estate. So 14,000 divided by 200,000 and change in equity is about a 6.8% return on equity. So all those numerators, the cash flow, appreciation, pay down, principal reduction, that's the numerator. Your denominator is the return on equity. And then when you divide $14,000 and change by $200,000 and change, I'm making about 7% return on equity, which is below the historic term of the stock market.
Let me interrupt you real quick, because typically the way, investors look at this is not based on what the current equity is, but based on the original money you put into it, right? So what you're saying is look at it a different way. Because if you're just looking at what the original money you put in, this looks like a fantastic deal and great returns, and it is. But if you look at it based on just what the return on the current equity is, that's the mindset shift, correct?
Correct, because that was one of my big like aha moments as an investor was they're like, look, you have your money in there, but then you have to look at your equity because your equity in the property represents true opportunity cost. I can extract that equity, through a cash out refi, or I can sell and trade up if I want to. And so I'm not saying return equity is the right way to do it. I'm saying that's the way I look at it, because that $200,000 is real opportunity cost for me. And if I'm not using it, I'm using it on opportunity cost, right? So, hey, can I deploy that equity into a better investment, a better rental property to go out there and increase my cash flow and increase my longer term net worth growth? So I think return on equity trumps return on investment after a few years of owning the property.
Right. And I think you've explained this well, but just, for people like me to really understand this, you're saying I have a bucket of $200,000 plus of cash. And if I had that, where would I put it to get a return? And can I do that and get a return of better than 7%? Well, certainly if you're in syndications, you can. In the stock market, you probably can. And so keeping it in this condo asset really makes no sense, because the opportunity cost is you're missing out on better returns, even though, and really is just a shift in how you look at that equity versus your go-in equity as compared to your current equity.
Exactly. I'll show you actually kind of what I did with this property. I did a 1031 exchange with this specific property, and I bought a fourplex out here in the Denver area, and I think I did a 4.5 debt. It was a 6 and about a quarter cap rate, 25% down payment, 6% cost to sell. And this was from a high level kind of compare to show, hey, this is my thought. Hey, I can go out there and increase my return on equity and increase my cash flow. Because I realized that, hey, we want cash flow. A lot of times the way we get future cash flow is you buy bigger and better assets and then let, time do its magic in real estate. And then this was very similar to the trade I did. The left here is a condo where I was making that, about 7% return equity. And then when I sold that property and I paid my 6% in, transaction cost, I now then use that 25% down payment and brought a little extra capital table for my 1031, bought a fourplex about $800,000. Well, the two big things here is my return equity tripled from about 7% to about 22%. And then my cash flow, 5X from about $1,600 a year to about $12,000 a year. So I made more cash flow today, and then I was making more future cash flow as that property, was paid off because I had 4 doors versus 1, right? And so my NOI was a lot greater when that property was paid off. So my plan was, hey, great, I got this asset. I'll keep 1031ing forever, or a cash out refi when it makes sense. And that was my plan until the numbers stopped working.
So when the numbers stopped working, Chris, what was the next step for you to transition? I understand you've created a cohort. You've now got this framework in place that's been successful for you. Explain to us what that framework looks like. And if an investor were to join your cohort, what would they essentially get from a value proposition standpoint? What
I did was I put together a very basic framework and my attitude, and I used to run a very successful brokerage out here in Denver. I'd sit down with my clients and we do an annual portfolio review. Same thing you do with your financial planner and stock, same thing we're supposed to do with our physician every single year, because you fundamentally have 3 things with every property in your portfolio. You can keep the property. So, hey, keep it and you can increase the rents. You increase, operating efficiency. You can pivot from a long-term rental to a short-term rental and go out there and just maximize the cash flow on the property. But you can only do so much with certain properties, right? So that's one option. Second option is you can go out there and do a cash out refinance. Which worked great when rates were in the 3s and 4s. Hard now in the high interest rate environment we're in. The third option is sell the property and do a 1031 or reinvest. And so I had always been really focused on, hey, let's maximize the property. But Denver, like all markets, appreciation so outpaced rents. We saw, efficiency and cap rates compress greatly. I think a lot of us are familiar with the term negative leverage. If I put 7% debt on 4% cap rates, I'm negative leverage, right? We want to have cap rates higher than interest rates, generally speaking. And the third is sell the property. So I'd done all those, man, the math stops working. One of my big aha moments, again, this was the next big mental shift in my journey was when my mentor said, hey, I was very much in 1031 only. I can only do 1031 exchange. I never pay taxes. And he sat down and showed me a spreadsheet and he's like, look, sometimes paying taxes actually it makes the most sense. If you sell this property and you pay some taxes, but you invest it in an investment that's going to be 2x the return, you will overcome that tax hurdle. Hopefully that makes sense. But I was looking at the opportunity cost of my properties. I had a ceiling for how much I could increase the efficiency on those properties. The numbers no longer made sense in the Denver market for the strategy. The other thing was I was at a time where personally, business was taking a lot of my time. Family was taking a lot of time, and any like sweat equity or like, time gains I'd put into the property, I was no longer getting like a great return. I'm like, hey, Greg, I could put more time on my property for $20 an hour, or I should work in my business where I make $200 an hour, right? For very simple numbers. So I just kind of kept looking around, hey, what makes the most sense? So the framework here is whether you're a passive investor, an active investor, like a lot of us, you have a blend of the both, right? Every single year, do a full audit of your portfolio. How are things performing? How are things doing? And be realistic for how are these properties performing and what's the opportunity cost? And try to extract emotion from there. And for a lot of people in markets, it no longer makes sense. So I built that framework. It's helped me transition a little bit over half of my portfolio. I've helped all my clients here in Denver and, learned a lot from other people as well, watching them transition. What we're doing with PassivePockets is the active to passive transformation cohort. We actually go through the exact same framework. Hey, let's go through and analyze your property. Keep it, refi, or sell. And we're not saying going from past the best thing, but first understand how your properties are performing and then also realign your goals, right? Most people start investing 5, 10, 20 years ago. They don't come back and revisit their goals. Hey, what's your cash flow goal? And how much time do you want to put in your properties anymore? So we go through a very methodical process and you figure out, hey, what makes the most sense to the market, the opportunities you have, and how your properties are performing.
Let's dig into it a little bit. We're calling it a cohort. Is that kind of like a mastermind, a program, a course that people take, and you're walking them through and saying, okay, let's review all of your active properties? So is the process for people that want to just evaluate their active real estate, or those that know they want to be less active? Both, all of the above? Can you just talk about who this program might be for?
I would say it's both. I mean, this is not a beginner program. This is for intermediate to the advanced type investors with at least, a handful of properties, a decent chunk of equity, and something that we've talked about the last 20 minutes resonates with them. Hey, I no longer want to put a bunch of time on my properties. My local market has shifted. I want to learn, hey, how can I optimize portfolio? And maybe I want to start investing passively. And that may mean rather than buying new rentals, you just pivot your down payment money to passive investments. Or you might do what I did. I know you do this too, Jim. You start selling some assets and then you transition the money over towards passive investing as well. So it's a 5-week program where it's 10 sessions, 5 are educational, and then 5 are like office hours or masterminds. And we're doing all through the PassivePockets community on there. So people can learn, hey, week 1 is analyze your portfolio. Week 2 is learn how to evaluate passive deals and learn the structure. Because one of the cool things about passive investing, we all know, you can slice and dice returns you want. Oh, I want cash flow? Go invest in a debt fund or go invest in a high cash flow, triple net or some asset like that. Week 3 is understanding tax consequences because there are some smart ways you can do it. Week 4 is creating your personalized plan because everyone has a unique portfolio, unique goals. So it's creating a custom plan for you. And then week 5 is about leaning into the community so you can learn from others and also get that community feedback for like, hey, Paul, this looks great, but consider this as well, right? So it's the program on there with using this portfolio tool I just showed you guys and also a bunch of spreadsheets as well.
Chris, I love the idea. Standalone, just looking at your portfolio holistically on an annual basis and kind of doing a diagnostic check around the return on equity conversation too, and looking at it from a different framework and seeing, hey, is this the best use of where my capital is parked today, or could I make it more efficient and align it with my goals? I've taken some of my active portfolio and taken the proceeds from profits I've had and reallocated into passive investments. For me, it was diversify away from myself. If I make mistakes, I've got somebody else that's, hopefully more talented than I am handling my capital, maybe in a different market, maybe in a different asset class. So that really appealed to me. But one of the things that I struggle with still today is giving up that control because I am an active investor as well. Maybe, for other people that you're working with that use a property management company for their active portfolio, that's a little bit less hands-on, right? But for those that self-manage, I can imagine this being like really difficult to relinquish that control and give it up and then reallocate passively with some other sponsor. How did you personally overcome that when you were an active landlord and transitioning to passive investing?
Yeah, well, that's kind of the catch-22, right? A lot of times we get great returns in real estate as we're hands-on operators. I'd say it hit a point where like my mental bandwidth was just maxed out, and I was like, hey, I'm no longer loving it like I used to. And I do want to diversify, like you mentioned, Paul. I think it kind of comes down a lot of times is two things. A lot of times people have a couple assets that make a lot of sense. Hey, these are great assets. They're relatively easy to manage. I'm going to hold on to these. Maybe the rest you go out there and optimize or sell and transition. But it also comes down to having a very frank, mental conversation with yourself of giving up that control. And that is hard to do. But I actually think active landlords have a huge advantage here because the fundamentals of underwriting a property. The BS. Like we've all had tenants destroy a unit. I've been in deals where, hey, I bought that property and kind of like too close to this, major road, and my rent comps were about 10% lower than I thought because it was near, just not the ideal situation. So I think there's a lot of benefits that landlords can use out there to really leverage their skill set. That's probably like 80% what you need for like passive underwriting. And then the other part, there's learning how to essentially underwrite the sponsor, underwrite the operator. And since we've all been in the trenches, we all have really good, BS detectors. And you can talk to someone, hey, tell me about these rent comps here. Tell me about this. And if they can't answer that, or we've all seen the never-ending 10% increases and rents forever going, like, we all know that's BS as a landlord, right? You can use that to sniff it out. And so you have to understand that, hey, you have all these skills, you have all this knowledge, and then have you built a lot of your wealth up and a lot of the wisdom, right? I've got gray hairs. I know you guys are getting some gray hairs as well. Use that wisdom to go out there and help you underwrite the deals, underwrite the operators, and you can go from like more of a hands-on investor to being more like a capital deployer and capital allocator with making things work for you.
Paul, you said something there, and I think we're trying to get at it. Like, if you're an active landlord, it's control is something that you're used to and maybe you like. But the one thing you're missing out on, almost every single active investor is missing out on the one thing that is the easiest to obtain as a passive syndication investor, and that's true diversification, right? Because if you're an active landlord, you cannot diversify by operator, right? You probably can't diversify by asset class, and maybe you can diversify by market, but it's not very many different markets, right? Chris, you're just in Denver. I know, Paul, you're in a couple different places, but I think that's the thing is control versus diversification. And so maybe you don't sell everything like I did. I did it all without a plan. I'm just like, hey, passive syndication sound great. Let's dump everything and do something different. Chris has a much better way to do it. But I think what people really need to focus on is, okay, yes, I'm giving up some control, but I'm getting so much more. And then, Chris, I do want to touch on something you mentioned in your cohort, the program. You mentioned community. And anyone who's ever listened to me on this podcast or guesting on other podcasts, when someone says community, I can't shut up because it's so valuable and important to me. And when you're talking about community in this cohort, are you talking about the other people in the program exchanging ideas and working together? Is that kind of like a mastermind almost? Is that the kind of community you're talking about? Can you explain community in the sense that you are referencing here?
I'm a big believer in hey, the more I share, the wealthier I get. And I think that's how a lot of real estate investors, and entrepreneurs just kind of view things, right? Hey, the more we collaborate, like, hey, Paul, you have different thoughts. You've had different great things and you've taken different black eyes than I have, right? I can propose a plan and then you're like, hey, what about this? And it's really good to get that feedback and learn from your wins and also your mistakes. And one of the things I love about passive investing is I think it's less of a zero-sum game than active investing. So let's say we all just hypothetically, we all live here in Denver, Colorado, right? And we're all, buying rental properties and we all see a great wholesale deal or a great property pops up. Well, if I buy it, you guys don't own it. I win, you lose. But let's say we invest in an operator that needs, $5 million for a project. Well, if I invest $100,000 into it, and I'm also collaborating with Paul and Jim and other community members, hey, does this deal make sense? Hey, Paul, this is in Ohio. You know the market better. Go drive by it. Tell me about it. We can share a lot more thoughts and benefits on it because we can share our skill sets. But we all can say, hey, this looks great. Or I bring my piece of due diligence and thoughts to the piece along with you guys and the community members, it's less of a zero-sum game because you're all throwing $100,000 in there, and I'm not taking the entire slice of the pie.
Yeah, and you've got people that you can lean on to do due diligence, that you can lean on to say, hey, you just talked to so-and-so operator. How was the call? What did they tell you? And you can share information. And it's not like it's group investing necessarily, but there is a little bit more of a layer of accountability there and a little bit more of a way to keep yourself, I think, on track by utilizing the members of the community and gaining from their skill sets and filling in the gaps that maybe you don't have. So I really like that. I never really thought of it that way, but I think that's a really smart way to look at the overall space. I want to go back to a comment that you made prior to Jim's last question regarding getting comfortable investing passively. And one of the big things you have to really get comfortable with is the person you're investing in, the sponsor. Do you have a formal or is it more informal process for vetting sponsors and operators? I know we could probably make this into a separate episode all by itself, but just a general framework of how you get involved with an individual that's new to you. What's your strategy as far as how you approach that?
Well, I think we actually did an episode on this like 6 months ago, right? I think we did. So I would say we should link back to that. I don't know what podcast number that is, but like we've had lots of really fun internal discussions about that process. We should link that episode in there. High level, I always look at, hey, operator experience, right? Like I will not invest in anyone's first deal or first rodeo. We all have to get that monkey off our back. Great. I got off my back on my own. You get off your back on your own. So it has to be experience. I much prefer teams versus solopreneurs because there's too much key man risk. Hey, Bob over here might be an amazing operator, but if Bob unfortunately gets hit by someone on the freeway, well, then that's too much key man risk in the business. And then I like to look at the market. Hey, what market are they in? What's the fundamentals on there? What strategy they're doing? Does the strategy make sense in the macro conditions? Does it make sense in the current conditions? I like to see operators who are investing alongside their GP co-investing. It's not just my money and our money, but they're throwing in a couple bucks as well. So I look through all those things. And then I also go a lot on my gut and I also go a lot on what other community members say. Like, for example, I was actually in one of the PassivePockets forums today, and there was a deal sponsor you guys had on the show just a few weeks ago, and Denver based, and a lot of people in discussion, hey, tell me about this person who's invested. And I go like, hey, I've known this guy for 10 years. I've known the operator, I've known the business. I haven't personally invested, but look, our paths have crossed. Like, that's really good feedback for other people in there because like we've done all sorts of items together or crossover in our network. And so it's great to provide feedback when I can, but also hear other people's feedback as well. So I think that is just a huge benefit to, using the community to help underwrite you as well. If we have time, I want to go back, and Jim, because you touched on my favorite things, which was diversification. Can we loop back to that for a minute?
Absolutely. Yeah. Go for it.
My college degree is actually in financial planning. I have all the certified financial planner education requirements. That's very much like my mindset. Just for clarity, I'm not a certified financial planner. I don't manage people's monies or anything like that, but like that mindset and that education was very beneficial to me in my 20s, right? I learned how to like the basics of money. And of course, diversification is so important. And so when I started in real estate, I got all these rental properties, I'm diversified away from the stock market, right? My S&P 500 investments. Well, then all of a sudden I was like, wow, I've got the majority of my net worth between real estate investments and business within that 25-mile radius of core Denver. I kind of got so highly concentrated, I started losing diversification. As I was trying to figure out, hey, how can I diversify? And this was, I started going into passive investing. I identified 5 kind of like pillars for passive investing. One is operator, right? Myself or other operators, I can get different exposure operators. One is market. I can diversify outside like the Denver market and Colorado market. Third is asset class, right? I know residential properties, nothing else. Third is strategy. Are we doing ground up development? Are we doing value add? Are we doing turnkey? And then the other is capital stack diversification, where up until I started, probably year 2 of my passive investing, I'd always just been on, equity or common equity, either me putting down a down payment or me investing in equity projects. Well, it's very easy to go out there and exposure to like the lending side of the capital stack, right? So I focus my portfolio now on those 5 pillars diversification. And I am really glad I did, because seeing how the markets happened last 3 years, especially Colorado has had some major headwinds from just market conditions and some legislative conditions as well. If I kept my portfolio here, my net worth and cash flow would be significantly less. than if I had not diversified across the markets, operators, and different asset classes.
That's fantastic. The 5 pillars of diversification there. I might add a couple more. One is the expected term, right? Is it a 5-year deal, a 7-year hold, a 10-year? Get a couple longer ones and a few shorter ones in there. And then also even the type of debt. I think you mentioned debt, but type of debt and also term on the debt. So there's a lot of different ways to diversify. And the point here is not that you have the exact same 5 diversification pillars as Chris, but that you have them, right? And you understand, because I think too many times, I know when I started, I was like, diversification, that's operator, market, and asset class, and that's it. But you added a couple more in there, and then I have a couple more, and I'm sure everybody would have a few more. So I think that's fantastic. I'm glad you brought that up. We are getting to the end here, Chris, so I would like to ask if people are interested in your course, the cohort, joining, understanding what's happening, what's the best way to get rolling on that?
Yeah, so the cohort launches July 28th, 2025. So it's coming up really, really soon here. And I have done a few iterations of these locally here in Denver, just with my community around here. And so I have learned that since this is so much information and there's so much on here, like I'm a big fan of doing it live and with the community. It's very hard to go through like a pre-record session, do it solo. So we're doing it live on there. So it starts July 28th is the first educational session. We start the 5 weeks. We will link out there to the sales page here in the show notes, hopefully. And then the price is $399, which I think personally is an absolute steal. When I ran all this through AI for like, hey, tell me the critiques, how would you price it? The different AMLs, like, hey, this is worth between about $6,000 and $12,000. But this is one of the things I really appreciate, like about the BiggerPockets and the PassivePockets community, is they've always been focused on, hey, let's not go out there and charge $10,000, $20,000, $40,000 for educational programs, because that's your freaking down payment or investment, right? Like, hey, instead, provide amazing value. Couple $100 in to get it in, and then, hey, that $10,000 in savings, I can go out there and use that for a partial down payment or a partial, LP investment. So we go live July 28th, and then we also do have a special coupon code for PassivePockets members that will save you $100. I will not share it on this podcast because it's outside the membership community. But we will create a thread in the forum on PassivePockets with the coupon code and link to it. Or if any PassivePockets need the coupon code, email me, Jim, or Paul, and we'll give that coupon code as well. But I am very excited to launch the cohort. I'm very excited to teach this. I'm also really excited to learn from other people, because every time I do this, I always learn from other people. Like you just mentioned some really great diversification pillars, Jim. I might need to go to 6 or 7 diversification pillars now, right? And so I'm just excited to go out there and launch it. And of course, I think we talked high level. You guys are gonna be involved in this as well, to bring your insight, your expertise to teach community, and also just learn from you guys as well.
Yeah, that's great stuff.
I just think it's amazing that you've put together such a valuable resource at such a low cost. But I think it's more than just for that individual that's looking to potentially transfer their active portfolio to passive. I think this is something that can be beneficial to really anybody. We talked about return on equity and just looking at your portfolio and the efficiency of it and how it relates to your goals. I think that can be an overarching theme for anybody to latch on to. And I know I'm going to learn a lot from what you've got going on, Chris. So thank you.
Yeah. And the last thing I'll say, $400, man, if you can take one of my active properties that's giving me 7% return on, equity and make it a 10 or a 12 or a 14, I mean, that's paid for it right there. So also listeners, if you want to connect with me, Paul, or Chris, we're all on PassivePockets. You can DM us. If you're not and you want more information on that, you can contact me, email me, jimpfeiffer@biggerpockets.com, and I can give you the code and connect you with Chris. So Chris, thank you very much. Loved having you on. This is fantastic. Appreciate it.
Thank you, guys.
From identifying misalignment to creating a framework for change, Chris Lopez reminded us that sometimes the most powerful move an investor can make is to pause and rethink the portfolio.
If today's episode brought you value, don't forget to sign up for Chris's cohort, Active to Passive, before July 28th. You don't want to miss it. Make sure you subscribe, and visit PassivePockets.com for that 7-day free trial and access to our limited partner community. Thanks for listening, and happy investing.